Welcome back to the Everything Property Podcast. Now, leading on from the podcast last week with Jordan de Jong from Game Plans, we looked at how many properties you need to retire at 3 different price points. Well, I guess that leads you as the audience into your next question. Where on earth do I find properties at these price points? Well, don't I have the absolute best podcast episode for you today? Joining us is a guy who's been at the forefront of revolutionizing the property industry with technology that makes researching property a hell of a lot easier for investors and property professionals, allowing them to find higher than average growth for their next purchase. This guy's done a PhD, and over the last 6.5 years, he and the company he co-founded has been a pillar of property knowledge, education, and the source for so many people in the property industry. Mr. Mat Djolic, welcome to the Everything Property Podcast. How are you?
Thank you for having me, mate. That was a great intro. Thank you. I think you oversold it there.
No, look, that's all right. Anyone that listens to any episode will know I pump them up on the intro and we start on a really good note. But, mate, you have a really interesting background, and what I wanted to get into today was a little bit around, for the audience who don't know you, but I mean, you've been on this journey with your company that you co-founded, which is called Higher Than Average Growth. Sneaky little product placement in the intro there. But I guess for people that don't know you, how does someone get involved in proptech and the platform that you guys built? Like, why on earth would you do it? You know, tell me.
Yeah, it was an interesting journey. I mean, when I moved to Australia in 2000s, like everyone else, I started working as a tradie on site. And then just, it was a 7 to 3 kind of gig, and that I felt like I'm in prison essentially. And I wanted to see what I can do about, getting myself out. So I started researching about property, going to different, let's say, seminars and all of that. And I was doing it for a while though, like for about 3 or 4 years. I think I nearly read every book on property and development out there that exists. I remember I even went to New South Wales Uni. At the time I was doing a master's at New South Wales Uni, and I went to a professor who was doing a property development course, and I've asked him what books they have essentially, so I can actually read that as well. I accumulated a fair amount of knowledge there, and but I couldn't actually materialize that into a platform before this is when I sort of met Alex, you know what I mean? Alex is my co-founder, is the guy who actually helped me put that sort of in an online platform. Me was like just, essentially Excel spreadsheets, and, it wasn't really working, you know what I mean? But
it's a lot of work, the Excel spreadsheets.
I started investing myself essentially, but I realized, I guess the realization that this can be simplified. So I think the main reason where the idea came from is I realized there's a lot of information out there, but nothing is actually really connected into a story. I remember back then I was looking at, My Investment Property magazine, and they had at the back,
old school,
they had at the back, like for example, let's say vacancy rates, days on market and stuff. And I remember saying to myself, well, that's all good and well, but this is like just a point in time kind of thing. Like it's a snapshot. It doesn't tell me the trend, or it doesn't tell me how it's behaving overall. So I wanted to make it better, but I just didn't know how to. And then essentially I met Alex, who has tech background, and we sort of put our 2 minds together, and it happened. Let's say this is a short version.
Okay. Yeah. How long to build that platform, by the way? It's been you sort of, from what I can gather, it's you've been around, or you started 6.5 years ago.
That's right. Yeah.
What is the build phase of a mammoth like that?
Yeah. So I mean, we've done so many things wrong.
That's all right.
And I guess that's the best way to go about it. We were building, or Alex was building. So the way we sort of split our responsibilities was, Alex essentially builds a product, and then I test it and provide advice when it comes to, what will serve better. Because the aim and the intent is for the user, which was me and Alex initially, is to make the best possible decision at the, shortest period of time. And in order to do that, there's a lot of complexity there. So he would build, I would test, I would tell him, let's do this, let's try that. And we never focused on community building from the onset. We were focusing on the product itself. And I think if anyone starts a business, whether it's in proptech or anything else, I think the primary thing would be first to actually build a community and then you release a product. So we've done it the other way around because we didn't know. So in the first 4 years, it was essentially building. You know, I don't think we even spent $1 of marketing in the first 4 years. And we did have signups, but I think it's just, you know, people finding out and searching and all of that. And our goal wasn't, because that was our part-time gig back then. So our goal wasn't to actually acquire customers. It was first to build a product that works, and then we'll market it, you know. If I look back retrospectively, would I do it differently? I think I would do the community building first. And sort of build and iterate as I go, because I'll be collecting feedback from the community itself. But, you know, it sort of, I guess, it worked out well because, you know, you try to make it perfect. And when you try to make it perfect, you really, really drill down into things. And, yeah, I mean, this is sort of how it came about.
Perfect. Well, look, let's... That's pretty interesting, and a couple of little points there for anyone thinking about jumping into business. But I think what's good about your two pairing is that Alex does that building and has that tech side, and then you've got sort of that. You guys don't clash in your skill sets, so you aren't both two guys button heads about how to build it. You come at it from a very different perspective, where Alex comes at it from like how am I going to build that to answer this guy's question. You're kind of like the target market that he's building it with.
That's right. So as I said, I'm a mystery shopper, you know. But the thing is, though, I mean, we spoke about this before. You know, building something. You just, you know, you need two people. I mean, it's very hard to build a business with a friend, as I said to you before. But if you do, you know, there can't be any sensitivity. You have to be ruthless, you know what I mean, to try to. Because essentially, I think when you build something, you know, you have to think about it in terms of you building it for yourself as a customer, and you want perfection, you know. And you try to do the best thing that you can. And see, where we sort of vary, Alex is the type of guy who likes a lean methodology, in a sense that, you know, release it and then develop. I'm not like that as a personality. I like to be perfect right away, and then you release. And sort of this clash was, you know, that was where main friction happened. But I think through these, you know, brainstorming sessions, a lot of things came through. And it's interesting, you know, like, you know, what's your ideal customer profile? Who is buying it? You know, we sort of stumbled on the fact that, you know, buyers agents are adopting our platform without even knowing. We actually wanted to build it for property investors. For me, essentially, as a property investor. For the everyday, but then a lot of our audience. Then he was the buyer's agent, you know. So, I think you need different skill sets, especially, but you also need a personality trait that is not too sensitive. I think that's the key to working out things with your business partner.
Didn't hurt your feelings, mate. You got to get that MVP out and then iterate. You never, whatever you post, whatever you're trying to make, it's not going to be perfect first half.
I mean,
sorry to tell you.
No, absolutely. You know, but this is how I approached my life before. You know, which is why I submit myself essentially to a lot of stress. You know, like everything I do, even. You know, like even everything that I try to do is like, you know, you try to think of every possible iteration of an answer. It's like playing chess. You know what I mean? So you try to anticipate what the opponent will do and to develop the best move. So if we're introducing a new feature, or let's say part of the platform, I'm trying to think how you're going to use it and what faults you're going to find with it as an individual who invests in property and needs to achieve a certain goal. And when you do that, you go into this loop that can be a bit dangerous, you know what I mean? But I do agree. It's just annoying when you put out something that you know is not 100% there to me. It's like itching my skin, you know what I mean? That's my personality.
Perfectionist. Look, there's nothing wrong with that. There's nothing wrong with that. Well, look, let's dive in. Let's dive into the platform. So anyone listening to this at home as a podcast episode, I would recommend both listening to it, and what we're going to do, we've got Alex set up in the studio with his laptop too. We've got a screen recording. So if you look at the long form on, say, YouTube, you'll be able to follow along and see what he's going to. What I'm also going to try to do as best as possible, and understanding that for a software like this, maybe not everyone has access to it, or, you know, hasn't subscribed or signed up or don't want to, trying to keep their expenses very lean. I'm going to try to pull apart as best as possible with a few of these data points where maybe the person listening can find these, if it's a free set or if it's a paid set, or where they can find some of these points. But Look, let's dive into it. So when we spoke with Jordan about how many properties and stuff you need to retire, we looked at 3 price points. We looked at 350,000, 500,000, and 750,000. Now, take us through. If let's start at 350,000. If I say that to you, Matt, and I say that's what our budget is, and we're obviously looking for growth. How are you taking us through? If we start at and if you can see, there's a map of Australia on Matt's screen with plenty of different blue shades and stuff, but where are we starting? How are we going from looking at the whole of Australia, getting down to a state level? What sort of data sets do we start at to sort of qualify down to that $350,000 price?
So, I mean, those are perfect price points, by the way, because they essentially talk to, 3 different mindsets and strategies. One thing that is very important when you're researching is that you have to have, before I dive into the platform, I need to say this. You have to have a well-articulated investment thesis or research thesis. And what that means is that you have to understand the chain reaction between your price, your strategy, your location, and the asset selection. So we always see, and most of the times we see a misunderstanding in the investment space where people jump from budget to an asset, eliminating the location, and location gives you 70 or 80% of growth, and that's been researched to death, academically.
Yep.
I always say you can buy, a great asset in a shit area and you'll still see minimal growth, So, but you also, what's upfront, what is not, I guess, addressed in the industry that I see a huge gap is this strategy piece. So if I have 350K to spend, you have to understand that you can't buy a Ferrari with that. And when you can't buy a Ferrari, you buy a subpar area. You have to understand there are certain risks inherent in that area, which is why the area is 350K in value. It's not 700, it's 350. So the question is then you have to ask yourself, what can I get from that investment? And what's possible, by answering that question, what is possible, that is going to drive your filtering strategy and how you select the location. So let me be a bit more, I guess, concrete and not too abstract. So 350K, those areas usually are underpinned by, let's say that I always talk about economics of the area. Let's consider a GDP of a particular area, gross domestic product. You know what I mean? Let's use that as a reference, as a proxy. So there's a certain GDP in an area that supports a 350K typical value, and there's a certain GDP that supports an area with 750K typical value. And usually that GDP has, different elements to it, whether it's median wages, whatever it is. Like it can be 20, 30, 50 indicators there. But that GDP can support certain amount of growth in the future. So you can't expect an area that's 350K in value to go to 900K. You can't expect an area within the first decade, let's say. You know what I mean? And
you hold it long enough, it will.
And you can't expect, potentially. But then the GDP, the substantial GDP, the underpinning of the area needs to change substantially in order to support that growth. So you can't see a 300% growth in values of a property and then no wage growth in that area. So how is that being substantiated? You can't do that. So a lot of people come and say, okay, I've got 350K to spend. I want both cash flow and growth. Well, you can't get it. Simple. You can get some growth, absolutely. And you can get growth maybe within the first 2 years, 3 years, in 10 years, but you can't get it above average 5% compounded every year for a decade. You can't do that. So because it's a cash flow dominant area. But what you can do is make sure that you address risk of that area to make sure that that area grows a little and doesn't decline, because that 350K sweet spot has a lot of potential to decline, has a lot of potential to stagnate. And when you're researching, the first thing that you need to do for that low value ticket is address risk. People don't address risk in property investments for some reason, or they don't consider it. I'm not sure whether it's a lack of understanding what actually risk is, but essentially a risk in property investment is not making the right return and actually turning an asset into a liability, okay? So when you research for 350K, the first thing that you would do is what I usually do. I put a budget of 350. And see, this is the thing. What your budget actually defines your strategy, as I said before. So 350K is an area that's dominated by cash flow potential, not by capital growth. You can get balances of both, but cash flow is going to be more dominant.
Yeah. So and the reason we pick a 350K is the reason I've picked up for this episode and everything else. I think that's 350K is really your entry level. You know, if we're going too low into the 2s and the 1s, then it's like it's red flag territory. And as you said, there's heaps of high risk around those areas, and there's a reason why they're only one in 200 grand.
Absolutely, exactly.
They might go up, they might go down, but they are growing and dropping dramatically, which is not what you want. You want that steady growth. So that was why 350, extremely affordable to get into. You might only need 10% deposit, everything else 50K.
Yeah, so I had a lot of fathers who come to me and say they want to invest for their kids in that sort of price bracket. And, you know, usually when I try to do an area selection, there's this educational piece up front in telling them, you know, about the risk component. So the risk component in the 350K comes in 3 forms. It is data risk, i.e. the volume of sales, because everything in data is based on the volume of sales. The more sales you generate, the more accurate the data is that you're looking at. So data accuracy is extremely important, because what can happen in, let's say, areas that generate low volume of sales is that the data that you're looking at can change dramatically from one month to another. And then you can't plan for it. So data accuracy is extremely important. The second thing that you need to look at is economic diversification. This is extremely important because there's also a misconception in the property investment space that, for example, large infrastructure investments in an area lead to capital growth directly. Yeah. That's incorrect. Yep. And let me explain why. It all depends what kind of an infrastructure investment it is. If an infrastructure investment is centralized into a mining project, then that area is going to suffer after the mining project finishes essentially. Yep. And we've seen this in many different scenarios. For example, Newman in WA has generated 80% growth in the past 5 years, which is above 10% or a year, but yet it generated minus 50 in the last 10. So you can see the huge decline. Why? Because as soon as the mining project leaves, the area tanks essentially in growth. Yeah. So this is why you have to look at, say, a lot of people say, you know, oh yeah, I'll buy a property and I'll hold it for 5 years. That's all good and well, but you can't time when the mining project is going to finish. So you always have to have a long-term mindset to eliminate risk. So economic diversification is one thing that supports a steady growth in an area. If you have an undiversified economy, when macroeconomic conditions change, i.e. when, let's say it's agriculture, and let's say the macroeconomic conditions that support agriculture change completely, whether it's interest rates or whatever it is, imports, export, whatever it is, that area is going to suffer the most, and it's going to actually tank because it relies only on a single industry. So 350K, let's look at data risk. So the first thing that I do, I shift onto the suburb toggle because we look at councils. And by the way, the aim is to go as close to the purchase as you can. So the platform is built in a way that it's hierarchical, in a sense that you can move from national, state, city, suburb, or LGA suburb, but your search should always sort of bypass the hierarchy in a sense to come to a location where you're going to buy right away. Because when you're pinpointing an LGA information is aggregated, so it's averaged out. So essentially, you have areas in an LGA that perform extremely well, and then areas that don't perform well. And so you look at an LGA, and you can see that it's semi-okay. However, that's been aggregated from, you know, poor performance and good performance. Okay, so you're taking the average of maybe the best. Correct. So you need to bypass that. You need to specifically narrow your search to the point of purchase, where you're going to buy, what street you're going to buy in as well. So you go all the way down. So I switch onto the suburb. I usually expand to expert because this is when you get like 50 plus metrics introduced. And I always say to people, don't even look at the table because it can be overwhelming. So this is when it comes now to, you know, introducing filters that are supported by your investment thesis. We said that we need to look at data accuracy. The first thing that I do is I introduce confidence equals, and you have medium, high, and low. I make it high. I make it high right away. By the way, let's just, I'll cancel this. So 350K typical price, we have 143 entries out of 6,200 suburbs, essentially, that have statistical significance. There's 15,000 suburbs in Australia, but 6,000 only have statistical significance that you can actually make a decision on.
Why is that? Is that because the suburbs don't have enough?
Either new, not enough sales, not in demand. You have one sell this month and then a sell in the next 6 months.
Okay.
And you can't really make a decision on that.
Perfect.
Yeah.
So automatically you've just chopped down, we're looking for suburbs, you've just halved the suburbs that we need to look at because this...
Absolutely. So you're looking at 6,000 and then from the 6,000, if you put in 350K budget, you have only 143 possibilities.
Wow.
Okay.
Incredible.
Yeah, exactly. So this is how you cut the noise out right away.
Yep.
The next thing, when you insert data confidence.
Yeah, tell me about what is data confidence? Is that something you guys have brought into it, and how is that?
Yeah,
made?
so
I think I asked you about this. Maybe it was data confidence. There's something else as well on the platform that I asked you guys about ages ago.
I think it was affordability, but maybe it could be data confidence.
Yeah,
Actually, it was data confidence.
Yeah,
you're right.
Because I was like, how do you? Yeah, tell me.
So this is a perfect question for Alex because there's a mathematical equation behind it, but essentially it comes down to volume of sales. So high confidence areas usually generate on average, and this looks back into history as well. So on average, they generate 12 or more sales per quarter. Yep. Then those areas have high data confidence. Medium data confidence goes below that, and then you have low. I don't know the actual numbers, but it needs to generate 12 sales per quarter on average for a long period of time to have high data confidence.
Okay.
So sometimes, for example, you'll see, if you look at the sales column here.
What, a sale a week, really? A quarter? Yeah.
Yeah,
quarter,
well, that's the minimum. That's the minimum you're looking at.
I mean, let's be honest,
and it needs to be average. It needs to happen like that for a long period of time. So there needs to be a trend there,
Makes sense. Okay, I understand. Because if you have low confidence, like I'm just thinking through this, speaking out loud, because I really don't want to be basing my opinion off, if there's only been one sale every 6 months, you know?
You know what can happen? Absolutely, absolutely. So there's two things that can happen. First, the price can change dramatically. Let's say you sell a property in an area that's 800K, and then in the next 3 months you sell a $1.5 million property. What's the typical value of that area? How you come to that conclusion? There's too big of a disparity for you from two sales in order to average it out to a typical value.
Yeah,
so that's the first thing. The second thing is days on market, stock on market, supply and demand metrics can change dramatically from a month to a month. So for example, you can have, a days on market that's 25 days, which you consider opportunistic, and then next month or next quarter it becomes 135 days, which is catastrophic. And it's because you don't have enough sale volumes to keep track of all of this supply. And we have to think about this. Everything is generated from sales. That's the underpinning common denominator of nearly every metric, you know. So I guess that's what I'm saying. The higher certainty you have, the more sales generated, you have more certainty in the data that you're looking at. And if you're making decisions on data, that's one of the critical aspects, especially in 350K marks areas. Yeah. Because those areas are not in high demand. So if you buy, again, data risk, if you buy in a 350K suburb, you want to make sure right away, sale is an intersection between demand and supply. This is where demand meets supply. If you have substantial volume of sales, high confidence data in a 350K area, you've already eliminated a lot of risk there when it comes to investing. So just a simple metric, one metric, safeguards you from a lot of pain thereafter. The next thing that I look at, as I said, ignore.
So tell me, we went from 16,000 suburbs down to 143. Now you've changed the confidence of the data, which means there's been plenty of sales, so that you can be sure about what you're looking at.
That's right.
You've put that into high. How many have we went down to
34.
Now? 34 suburbs.
There's 34 suburbs.
Cool. All right. What's next?
In the entire Australia.
Wow.
So, and this is what I say to people: you can do whatever you want. You can invest however you want. But if you, again, coming back to I have a PhD and I've analyzed data last 10 years, and everything that you analyze needs to construct a well-reasoned argument. You cannot have holes in your argument. So if you're going to tell me that you want to invest in a 350K area that has very low confidence, I have to bring that to your attention, and I say it has low confidence. It is your decision to make that call. But to me, that's a hole in the argument. That's a gap there.
Yep.
That's a gap which, if you don't address it, you'll suffer down the track. Property investing or finding areas is a process of elimination. It's actually very easy. You need to eliminate.
Yeah, that's what I mean. We've eliminated from. We haven't even picked. We're getting rid of. Disqualify before you qualify, baby.
Do you know how many times I see, and we're digressing a little bit, sorry, I'm excited about this, that's why. So
yeah, no, we've got all day, man.
A lot of people say, oh, I love this area, let's say WA, and I know people are going to hate me for saying this, but, you know, anyway.
No, that's good, man.
I love this area in WA. I go, no problem, no worries. Why do you love it? Because it's grown substantially in the last 2 years. Okay, no problem. And then because I have 80 metrics on my platform, and then I would ask them 80 questions essentially. I don't. I go up to 3, and I see the answer that I get. And I go, okay, what's the economic diversification of this area? Well, first, I don't know, but if they say, yeah, it's a mining town, but there's been a lot of investment recently and government is putting in money. Okay, no problem, mate. That's fine. It's putting in money. But again, you need to start with a long-term horizon to eliminate risk. It is your prerogative whether you don't care about that. And a lot of people think I'm arguing with them about WA. I'm just looking at the data. To me, as an investor, I go through a process of elimination. I'm not going to invest in an area that is not diversified economically. Simple. You do whatever you want. So coming back to this one, 34, let's look at risk. And look at this column here, risk. So you see my cursor going over it.
Yeah. So is the bigger the blue bar, the higher the risk?
Bigger the blue bar, lower the risk.
Lower the risk. Okay.
Yeah. So this is an algorithm that Alex has created. It essentially takes into account 80 metrics, and I can produce links, either send it to you later, about the methodology of how we come to that. People can cross-reference this even on ABS because it includes that data also. But essentially, if you had to group it under 3 or let's say 2 important domains, it will be economic diversification and environmental risk. And by environmental risk, I mean flooding, bushfire, erosion. So that risk column takes into account all of that. On our platform, you can actually download Excel reports that separate this risk column into 3 different columns, which is 2, which is economic diversification and environmental risk. But for now on the platform, you just have it as a single score. So you can see, let's say, I think it's in an alphabetical order, but you can see how some areas have extremely high risk. The bars are very low. Let's say, look at this one. This one is sitting at 59. It is above average. And by the way, this is a relative score. And what that means is that it compares one area to every other area in Australia. It's not a predicting score in a sense that, see, let's say capital growth. It's going to predict 20% growth in the next year. No, what it does, it says area A will perform better than area B. It's a relative score.
Okay.
So when it comes to risk, when you're filtering out, I always include areas that are above average in risks, so above the score of 50. So you can play with the database how you like on the basis of how many results you retrieve, but I start with this kind of 50 mark. I don't set a too rigid score, i.e. 75 or above, because I might eliminate areas that have a risk score of 60 and have phenomenal supply and demand dynamics. You know what I mean? So I want above average in lack of risk, essentially. So this is when...
Just quickly, the 350 filter, is that the average price?
That's a typical price in the area.
Typical?
And I call it typical. We produced a metrical typical price. We don't work on medians because medians are too sporadic and unreliable to consider. And again, we've published a methodology on our website on how it actually works. And you'll see 2 graphs and you see a scatter plot of purchases and mediums work in a zigzag manner. Our typical price works in a straight line and curve. So it's much more reliable when it comes to understanding how much property costs in a particular area. So this is area-based, So 350, and by the way, when you say 350, then you might go to a particular area and you might find the property that's 250, you know? So...
what about in an area that if I do, let's just say, sorry to sort of, we're going on a tangent, but if I set this at 400K, could I still find properties for 350 in that area?
Absolutely, you can. Well, absolutely. I mean, you had in that area, and that's a great question, by the way, and it's a perfect segue into something that I wanted to mention. So You can set the score, and we have many buyers agents doing that with our platform. They set the score a bit higher, the price a bit higher, let's say 50 grand extra, and then to find a better area with better dynamics, and then they hunt for property that's within their price range. Okay. Because obviously within an area, you have property that's under typical value, over typical value.
Yeah.
Another thing that you can also do is that the platform allows you, see the bedrooms filter?
Yeah.
At the moment, we have all, which includes all types of bedrooms. And mostly it's skewed towards 4-bedroom because of the value, yeah? But if you enable any, what happens is that you get, suddenly we have 59 instead of 34 entries. Okay. So you get areas that have 3-bedroom property, for example. So you have 2, 3. So let's say in this area here, you have 2 and 3-bedroom properties. Yep. And look, 349. See, for example, this area probably wouldn't have been in if I didn't enable the any filter. You know, it would have been, 4-bedroom properties probably in this area are higher than our budget, but now it's suddenly included because the 3-bedroom properties are underneath our budget. Yeah, okay. So if you want to cast a wider net again, you can enable the any filter. But going back to risk, I usually do this last. Let's put it to all, just so you can see how the
should we be bumping that search price up to 400 grand then, just to be able to capture all those markets, give everyone the best opportunity?
Absolutely, but let's. I think this is more of an educational process than trying to find the right suburb.
Okay.
Let me show you what you can get for 350 when you have the right thesis.
Okay.
And then we come back and I'll change it so we can adjust it. So, going back to risk, a lower risk score greater than, I will put 50. Okay, suddenly we have only 2 entries from a 6,000 suburbs. Do you know what I mean? Yeah. So, and then, I mean, I'm not going to introduce any more filters because obviously the filtering itself now is too rigid in a sense that it has reduced 6,000 suburbs to 2. If you want to adjust it, you can put 40, you can include medium, but the more risk you include, the more risk you're going to carry. It is your decision. So if we go all the way back, we can see that the risk score above 50. I'll address these scores later, but essentially you're just working with 2 suburbs. Yep. Going back to, let's put the any filter, and let's see if we're going to include, okay. So you have 12. 12, again, some of these suburbs actually repeat because, for example, in Broken Hill, you have 2, 3, and 4-bedroom homes. In Horsham, you have 2. Mildura, you have 2. Yep. So you get more areas there. And then if you go back to 400, you have 27 entries. Okay. With the any filter, let's say if we put all, you have 7. Okay. There you go. You have 7 entries. So see, this is, but by the way, if you don't care about confidence and if you don't care about risk, you have 223 to consider. You do whatever you like. But if you're a researcher and you're methodical, these are the things that you need to consider, especially for this low value. Especially for the low value. Yep. And by the way, I mean, I find this as a positive. A lot of people think that, having more options is actually a good thing. Well, me retrieving only two areas to consider with reduced risk, that's perfect. I don't have to do, too big of an analysis, essentially, you know what I mean? But going back to data, risk, let me just introduce that. I just want to show, when you do retrieve the areas, which one would you pick and why? Is that, would you like to know that or?
Yeah, go on. The people are out here listening, they're waiting for it.
Yeah, so greater than, I mean, I produce a spreadsheet on the side that considers all of the metrics, but I can do it here now. This is now when you start looking at the table. So what is your strategy? Let's say our strategy is, okay, obviously because we've got 400K to spend, it's going to be a cash flow dominant area, but we want some growth to consider. So how does growth occur in an area? Essentially, growth equals an imbalance in supply and demand favoring demand, okay? So now that we've addressed risk, the next thing that you want to address, and I'm not going to insert the filter now because we have, only a couple of areas retrieved. You want to have an area that's diversified in economy, but where property is very affordable for its residents. So affordability is going to be one of the crucial metrics going forward in the next 5 years. Why I mean, a lot of people understand macroeconomic factors, rising interest rates, erosion of purchasing power, essentially. And this is why these days, you usually get a brief, oh, Matt, can you find me something for 550K and below? It's very rare these days that recently I've done 850, but it's like 850 once in a blue moon.
Yeah,
it's always 550 and below.
Yep.
So as a catalyst for growth, and now again, the next part of the thesis starts. So we've eliminated risk. The next thing that you want to consider is growth. The first thing for catalyst for growth is affordability. You choose, there's an affordability index we have.
Yep.
And it's essentially used to own a property. It considers median price within an area, considers current interest rates, as well as the price of the property. So the more affordable the property for its residents, the more, and I forgot to mention, game of researching or property investing is increasing the probability of a particular outcome. That this is something that I try to drill into people all the time when I speak to them. Your aim is to increase the probability of an outcome. So is it more probable that an area that's more affordable, has more affordable property, will grow in value more than an area that has unaffordable property? It's more probable that affordable.
Okay.
Correct. So affordability index is the next thing that I take into consideration.
Just quickly before on that, I've heard some people as well say that the unaffordability, it means people can't buy in there, so it needs people to rent. And it means that there will be more people that are in that area that can't buy that would then need to rent. If I'm an investor, I potentially could look at areas like that because I have then a bigger pool of people that are renting. What are your thoughts on something like that?
Well, again, we have to come back to what determines price growth. If your strategy is to generate equity and have capital growth, then you have to consider the volume of sales. If it's unaffordable, there's going to be less volume of sales. So property will be exchanging hands less and less. And that's how growth happens. All good and well, you're not going to have any property vacant for a long period of time. That's fine. But you're not going to get growth if people are not purchasing property if it's unaffordable. So it just depends what you want. I mean, if your strategy is capital growth, then you have to consider affordability and exchanging of hands. So properties and illiquid assets, in a sense that, it's not like shares or crypto or whatever where, you have volatility and it exchanges hands on daily or intraday basis, Property exchanges hands, and depends in areas, hold periods can be from 3 to 15 years, but, much less. So the more exchange happens, the more opportunity you have for a seller to increase the price, essentially. Do you know what I mean? Like, I'm not going to go into whether it's a buyer's or a seller's market, but I'm saying the price increase happens at the point of purchase. And you need the purchase for property to grow.
100%. I'm just playing devil's advocate.
No, absolutely. As I said, I'm intense, bro. Like I
love it. Let's keep going.
So affordability index is the next thing that I consider, and you can see here, you have 13.5.
Is that years?
Years to own. Yeah,
what's a good metric?
So
what are we looking for?
So consider the fact that it takes you 30 years to repay a home loan. So we put the threshold at 30 years. It's relative and contextual. Some areas that have 35 years to own, they're sort of red, but that's still very affordable. So, but in this instance, we have, everything is close to, this one is 13.5 years to own. You know what I mean? So you would consider affordability. Let's consider the next thing that influences growth, socioeconomics of the area. So this is a score that's developed by ABS, and it's called IRSAD. On our platform, it ranges from 1 to 10, 1 being socially disadvantaged area, 10 being socially advantageous area. So when you've addressed risk, you've addressed affordability, then address the socioeconomics of the area, because the better the socioeconomics of the area, the more potential there will be for growth, especially if compounded with affordability and a lack of risk. So see how you're constructing a story. You have to create linkages between metrics.
Love it.
Then you go IRSAD, there's a column here. See how we have, and see how, because it's 400K, we are inadvertently in, neutral or lower socioeconomic area. You can't have a 400K area that has a 10 out of 10 score. It's impossible. Remember how I discussed the GDP. So you have 2, 3s, 1s, 2, 1s, 2s, So bottom line is I wouldn't do the analysis from this point. I would usually, let's say, expand to a suburb page, and you have to have a system of analyzing All of our suburb pages essentially are presented as, or metrics are presented as cards.
Yep.
And you address all of the cards essentially on the suburb page. Just to give you a few things, for example, when you're analysing cards and determining.
So we've went into the suburb
of Deliquin, I think. I can't pronounce it.
Deniliquin,
New South Wales. Yeah.
Yep. I'm going to jump on realestate.com as you're doing that just to see what I can get in.
Yeah, no. So the typical price is 379K. Yield is nearly 5%. See how it's higher. Rent is 330 per week. So, and just to remember, we found these areas have been delineated on two primary metrics, which is confidence and risk. Mm-hmm. But now you want to go in deeper and analyze it. So you analyze all of the cards. Look at the Niliquins, for example, price growth. You can see a curve that's been increasing. You analyze everything. You analyze the curve. You analyze the volume of sales behind. Mm-hmm. See, what I'm actually concerned about is you see a price increase in the Niliquin, but you see a substantial drop in the volume of sales. So this is not sound economics. Usually when volumes of sales rise, so look at this volume of sales here. So you can potentially, there was a lag between growth and volume of sales. Do you see? See, this is volume of sales. Let me just turn this off. So if I turn off the typical price, so look at the volume of sales here, how it's high.
Yep. What I can't see that on my screen, but what year we got there? What
we got between 2020 and 2022.
Yep.
I would say the printer was going berserk during COVID, so people were buying property.
Yep.
But you can see a substantial increase in sales, and then that's followed also by a price increase. You can see the tip going higher.
Yep. More people selling, more people buying. Yep.
Correct. The concern about this area, though, is, and again, you will never find the perfect alignment of metrics, especially in this price range. But the concern about this area is that you see a substantial drop in the volume of sales, and yet the price is tracking higher. My prediction, if I was going to make one just on the basis of this card, is that this low volume of sales will sooner or later start dragging the price down. You know what I mean?
So do you think that little glimpse there of where a lot of people have bought in that just little time period, that could have been like a COVID thing, affordability thing, or you're not too sure?
It can be many different factors.
Okay.
Absolutely. I mean, we can see that the volume of sales was increasing since 2016, essentially at this point here. Again, you have to consider in the context of macroeconomics, the fact that interest rates will go down potentially the next year. This volume of sales could rise, but when you're analyzing, I mark this with a red flag and I come back to it later.
Yep.
I want to see on a balance of probability whether that's going to outweigh the other area. Look at IRSAD, it's actually neutral. It's sitting at 3, which is pretty good for this low typical value suburb. We have renter to owner ratio, which is 26%, which is again opportunistic. I think above 35 is neutral or negative.
Yep.
We go further down.
Just quickly on that for people following at home.
Yep.
So that is, you've got a pie chart. 26% of the population rents.
Correct.
And 74% owns.
Correct.
Why is that ratio important of owner occupied versus renters? What happens when that starts to get over 30-35%? I know the answer, but I want you to say.
No, that's a great question. Like, it all depends. Like, in my view, I see that as a proxy to livability factor in the area. Mm-hmm. So if essentially, again, everything is common sense to me. So if people buy property and there's more owners in that area, that means there's potentially less turnover of property and less incoming supply coming in the future, because usually properties that are rented out are investors' own property, and that market can be more unstable and sensitive than the owner-occupier market. Mm-hmm. Yeah? So it talks to a lot of things. It talks about, again, it's a proxy. It's not a direct reflection of, but it's a proxy of future supply, and it's also a proxy of livability in that area. So those are the two things that I consider. Mm-hmm. How much weighting you place on this metric depends in what instance. When it comes to growth, I would give it, if we look at, a score of 1 to 5, I'll probably give it a 2.5, because there are more important metrics down below that I will consider. Mm-hmm. But I mean, it does talk to future potential supply and whether people want to live in the area.
Okay.
What would you say?
Yeah, no, perfect.
Yeah.
And I think if you have more owner-occupiers, you have more people that are they're proud of their house. They, look after their home a little bit more. They, especially when they're selling and stuff like that. When you have heaps of renters and then you have like a high renter population, I think as well, a lot of people, if they're renting, they might not be able to, don't look after the house as much. They don't really care too much. You can see that when you drive down the street.
Yeah, the assets are subpar, essentially.
Subpar, there's a high turnover, there's all those people going in and going out and leaving the area. So
a buyer's agent will always tell you that, when you buy an investment property, buy a property that would be desired by an owner-occupier.
Owner-occupier, I hear that. That's a little buzz line they all use, yep. Okay,
so
what else?
Going further down, I look at the GRC, which is growth rate cycle, and how are we with time? Am I talking too much?
You go as long as you want.
So GRC is the next metric that I look at, for example, and this is growth rate cycles. So you know how people say, property moves in different cycles, and even that's sort of incomplete because every area moves in different cycles. In this area here, for example, we don't see actually any cyclical nature of behavior, but we do see that what is interesting about this area, even though it's 400K and below, it has never crossed the zero threshold line. And so this is the zero growth. It has actually never had negative growth, which is actually a very good sign for an area of that low typical value. So I place this, I give this a higher weighting than I do to this, for example, when I'm analyzing, to renter to owner ratio, just specifically because we're looking for growth. Yeah. So that's very interesting. We can see that it's tapering off and it's going to see less growth in the future. However, this is only a reversion to the mean projection. It should be taken with a grain of salt. And what I mean by that, if supply and demand dynamics are perfectly aligned for growth, this could rebound and go up. This is not a gospel, essentially, Okay.
It's just and what's that time period there of that graph over that you said it's never went below into negative
from
growth?
2009.
2009.
So from 2009. Wow. When I say never, that's right. From 2009 to now, it has never seen negative growth. And again, a lot of people say, past performance is not indicative of future performance. Absolutely. But as I always say, that's the only data point that we can analyze. I cannot make my decision.
Good point.
I cannot make my decision about future on future data points. Which is, it's ridiculous. But anyway, going back, so we see the affordability. It's very affordable for its residents. Essentially, I really like what I'm seeing, apart from, we said, dropping volume of sales. But let's see if that's going to continue in the future by looking at supply and demand. Now we came to supply and demand balance. On the left-hand side, we have supply cards. On the right-hand side, you have demand cards. What is very interesting about this area, if you guys can see, is that and when you're analyzing supply and demand, one thing is very important. So again, I mentioned that property is an illiquid asset. So you need to ascertain trend in metrics. When you have trend equals direction. And when you have a direction, you can anticipate what's going to happen in the future with higher accuracy. So if the trend in stock on market since 2020, which is last 4 or 5 years now nearly, has been going down. We can see the trend substantially reducing. It's actually a large drop. I'm looking at the trend now. I'm not looking at the changes sporadic. I'm looking at the trend. It's going down. Is there a higher probability, again, that word, that this trend is going to continue going down in the future, or less probability?
More.
Yeah, so there's a higher probability that it will reduce. So what we're seeing is
going one way,
we're seeing less and less property being supplied to the market. We also see that at the back end, so since 2023, we see a reduction in supply apart from these last 2 quarters in comparison to previous quarters. So not only is overall trend reducing, but the recent trend we see a reduction as well. Great sign. So stock on market reducing. Inventory, however, is increasing. And again, inventory is a supply metric. And for those who want to understand, so inventory, you can click on the eye icon in the top left-hand corner. It says inventory levels indicate the amount of stock available in relation to the average monthly sales. And it's usually months of supply. So inventory, so this supply metric is increasing. Which is a concern. This one's decreasing, this one's increasing. Building approvals are increasing, but I think overall we see only one approval. So this metric, I wouldn't, and building approvals, why is that a supply? That's a future supply metric. So you have to consider the recent supply or the immediate supply as well as future. In the next 2 years, am I going to see an influx of new property in the area? And if I will, that could dampen price growth of the asset that I acquire. So this is why you need to consider building approval ratios. Considering there's only one approval here, it's not a big deal. This metric here, hold periods. So while building approval talks to about future supply of new property, hold periods talks about future supply of existing homes. And remember how we discussed, again, you link metrics, you construct a narrative. We discussed with renter to owner ratio about livability, and I don't know if that's a word, I'm hoping it is.
It is. Yeah.
So livability as well as, future supply of existing homes with the renter to owner ratio. You pair that with hold periods and you get a much better picture. So at the moment, people are holding on average, and these are macro area cycles, on 9.77 years on average.
Wow.
Which is pretty good. It's a pretty good, that holding a lot. Considering it's a 400K typical value, people actually want to stay there. And we can see a bit of changes in sentiment, as in drops and then it goes up. But at the moment, it's actually above the trend, and the trend has been increasing. So it is a great sign. That's a great sign. Then let's look at the demand. We have days on market, and there are two things that you consider. You have consider days on market, its trend, and discounting, which is represented as a scatter plot. We see, and these are the two most important metrics. They're ordered in the, they're organized in the order of importance. If the stock on market is dropping, and yet days on market is also dropping, i.e. demand is increasing, there's a higher probability of price growth, and that immediate price growth, especially if you link it back with affordability. So what you have a property that's very affordable for its residents, and you also have a reducing supply and an increasing demand. That's what I call a perfect storm. And again, you cannot have a perfect alignment of all metrics, i.e. inventory is a bit, there's a flag there, but SOM and DOM are perfect. We see flat vacancy rates. And again, there are two, sometimes I get asked to find warm spots and sometimes I get asked to find hot spots. So so let's say warm spot would be an area that has substantially reducing supply and a flat demand. However, if we look at vacancy rates as a demand metric, if the vacancy rates are nosediving, i.e. there's less and less vacancies, what will happen, again, look at the story. What will happen is you'll see growth in rents, and rents will go to a point where it becomes more sensible to purchase a property. So a nosediving vacancy rates is a perfect leading indicator for increasing days on market later down the track in the next 1 or 2 years.
Increasing days on market.
Sorry, decreasing.
Yeah, okay.
Increasing demand.
Yeah. Cool.
For decreasing days on market. So in this instance, we see...
This is so good, this episode. This is so much value.
So,
huge.
So we see, the demand increasing, but vacancy rates remaining flat. However, look at the last trend. Look at the trend towards a nosedive. So you always have to look at long-term trend as well as recent trend. And this is what our RCS metric takes into account, what he spits out a score, but you can do this manually yourself.
Yep.
Overall, if I had to fault this area, I would fault inventory, and I would fault the reduction of sales or volume of sales in respect to price growth. So those are the two faults that I will give it. However, they're not dramatic because I'm very happy about the supply and demand balance combined with, so this is what you do. Combine these two tickets with affordability and IRSAD. It's got a neutral, close to neutral socioeconomics. This is very good. I like it. And see when people... Deliquin, I don't know how to pronounce it. It's probably, Deliquin. So, people say, okay, I want to invest 400K, and where do I buy? And let's say I say this area. They look on the map and they go, mate,
it's in the middle of nowhere.
It's the middle of nowhere.
Yeah.
No problem. We haven't addressed things such as when you go to the front page, and you can go to this last section here, you can address population. And you can say...
so what about, let me ask you that population size, because I've heard it, I've seen it quite a few places that people say, or people often recommend, not diving into an area that has a population of less than 10,000. Rule of thumb. General rule of thumb, it's in a few magazines, and it's general rule of thumb, sort of in the property industry, investing industry that's out there. Now, I'm looking at what we've just went through. Deniliquin has a population of
7,432.
Yes.
Yeah.
So, and your issue is when you get too low in population, you're at a risk then of, people can start leaving, and then you go on a decline. Whereas a lot of people say that 10,000 is a healthy population size. Is it about the size there, or do we just dive into the trend of population and see, is that going from 7 to 7.5 to 8, or has that 7,400 come down from 8,000? What are your thoughts on population size?
Okay, so there's a lot of answers here. So first one is you can have population as a factor that you do consider. Mm-hmm. How much weighting you put on it is your prerogative. I personally, I analyze data in a bit of a different way. So there's a lot of metrics that people consider when they're analyzing an area: rising median incomes, employment, etc., etc. So there's no direct correlation between, let's say, and I'll answer the population question, between high, medium incomes and price growth. And the same goes with population. There's no direct, there's indirect. And what that means is that you should look at metrics that reflect supply and demand on ground. So if you ask me, okay, Matt, should I invest in Deniliquin considering that it's only below 10,000 and there's a potential that people will leave and it will impact price, I go back to the graph and I say, why hasn't it happened in the past? Why? And then people say, but past behavior, okay. Past behavior is not indicative of future performance. Then I'll say, then tell me and give me proof how you're going to make a decision and how you're going to know for sure that people will leave this area.
Hey guys, David here. Look, unfortunately, we're going to have to cut this recording short for this week. And the only reason is because there's over 50 minutes still left in this conversation. So we're going to split it up over 2 weeks and post the second half next week. Now, you're going to want to tune in for that one, purely because we're going to finish off 350K. We're going to jump into the 500K and 750K price brackets, as well as some really interesting opportunities and some chances for our audience to be using this platform at a discounted price, as well as another giveaway. So look, tune back in for us next week as we drop the second half of this chat. I really hope that you enjoy the first half of it, and there's plenty more value to come.